Let's work exercise 14.19 out of chapter 14, related to analyzing the impacts of alternative forms of financing. So we have Kingston and Benson. As always, let's read through the problem, understand what's presented, and dive into the questions. Shown below is the liabilities and stockholders' equity section of the balance sheet for Jana Kingston Company and Mary Ann Benson Company. Each company has assets totaling $4.2 million. We've got Jana Kingston on the left. We see current liabilities of $300,000. This company does have long-term debt of $1.2 million, which carries 10%. Common stock at $20 par is $2 million, and retained earnings with cash paid dividends during the year of $220,000, and the retained earnings balance is $700,000. Mary Ann Benson, presented on the right, has more current liabilities of $600,000, but does not have any long-term debt. They also have common stock at $20 par, but this totals $2.9 million, and the same $700,000 of retained earnings. So between the two companies, we know they have $4.2 million in assets and also $4.2 million each in liabilities and owner's equity. Continuing the problem, for the year, each company has earned the same income before interest and taxes. So we see for both Kingston and Benson, $1.2 million of income before interest and taxes. However, because Kingston has the $1.2 million of long-term debt at 10%, must incur $120,000 of interest expense, whereas Benson has no debt, no long-term debt, and therefore is 0% interest. Because if Kingston's able to deduct their interest expense, their taxes are lower. And we see that net income for Kingston is $864,000 compared to Benson's $960,000. The problem closes with, at year end, the market price of Kingston's stock was $101 per share and Benson's was $63.50. Next, let's turn to our instructions. So we have 5 requirements here. My recommendation is to consider each of these individually and answer them as we go. If anything refers to a previous problem, we'll note it at that point. A, which company is more profitable in terms of return on total assets? So what this is saying is which company has the highest ROA. ROA is return on assets. So it's asking us which of the two companies has the highest ROA. So the formula for that is you will take net income and you will divide it by average return on assets. I'm sorry, average total assets. We're not given an average for this problem, so we'll just assume that the $4.2 million of total assets was the average for the year. All right, so let's take net income and average assets, and we'll set it up for Kingston and Benson. All right, let's refer to the problem and find this data. All right, Kingston's net income was $864,000 for the year, and their average total assets was $4.2 million. And so therefore, their return on total assets, the net income divided by the total assets, it's a percent, and that's 20.5%. Next, let's do Benson's. Benson's net income was $960,000, so that's higher than Kingston's, and their total assets were also $4.2 million. So therefore, their ratio for the return on assets, net income of $960,000 divided by average total assets of the same $4.2 million, results in 22.86%. And so the question's asking us, which company is more profitable in terms of return on total assets? So which one has the highest one? In our case, Mary Ann Benson Company is the more profitable in terms of return on total assets. So based on that ratio, Benson appears to be the better company. Next, B. Which company is more profitable in terms of return on common stockholders' equity? Okay. Which company has the highest ROE, return on equity? So our formula here is the same net income, but we're going to divide it by owner's equity. And our owner's equity here is only common stockholders' equity. That's the only item in our equity, plus retained earnings, but that makes total owner's equity. So we need our net income again, and we're going to need total common stockholders' equity. And then we'll be able to find which one has the highest return on common stockholders' equity. So as we did before, we'll set up the two companies, Kingston and Benson. The net income is the same as before, so we'll just copy that down. 864 for Kingston and 960 for Benson. And then the common stockholders' equity. So let's go find that in their balance sheets. So Kingston has common stock par of $2 million. Plus they have $700,000 of retained earnings. So they have $2.7 million of total common stock equity. So their return on this common stock equity, these investors have invested and left invested as retained earnings $2.7 million, and that has earned $864,000 of net income. So that ratio of net income divided by total common stockholders' equity is about 32%. For Benson, their net income is $960, and their owner's equity is $2.9 million of common stock, plus $700,000 of retained earnings, for a total of $3.6 million of total common stockholders' equity. Their return divided by total common stockholders' equity for Benson is about 2.67%. The problem is asking us which company is more profitable in terms of return on common stockholders' equity. So in this case, we switch to Kingston because theirs is a greater return on common stockholders' equity. C, which company has a greater net income per share of stock? And it continues to say that neither company issued or reacquired shares during the year. So neither company, as we know, companies can do that at any time during the year, issued additional shares of stock, and neither of them bought any back into treasury or canceled any shares. So the assumption there is that the number of shares outstanding is the same throughout the year. So let's see, which company has the highest net income per share of common stock? And that formula is going to be net income per share, means, of course, divide by number of shares outstanding. So we're going to have to find a quantity in this one. So far, we've been finding dollar amounts. We're going to need to look for a quantity. Net income and number of common shares outstanding. And as before, we'll do it for both Kingston and Benson. Net income, we've already found out previously, so let's just copy that down. And now we need to find the number of common shares for Kingston and Benson. So let's turn back to our balance sheet and see what the information we have is. So Kingston has $2 million of common stock outstanding with $20 par. So if we want to know the number of shares, we will need to divide the total dollar amount by the par. $2 million divided by 20, par value per share, means the quantity number of shares outstanding for Kingston is $100,000. We want to do the same thing for Benson. Benson has $2.9 million of common stock outstanding. Also a $20 par, so divide total dollars outstanding for par, which was 2.9 million, divide that by the par value per share to get the number of shares. 2.9 million total dollars of par value divided by each share carries $20 par means they have 145,000 shares outstanding. So our ratio of net income per share for Kingston, net income was 864. This company has 100,000 shares outstanding. So each share is attributed $8.64 of net income. For Benson, $960,000 of net income divided by their 145,000 shares outstanding is $6.62. So what we can take away from this is that even though Benson had the higher net income, they had the lower net income per share because they had more shares outstanding. So that's a trade-off between Kingston that opted to go with long-term debt carrying a 10% interest rate, meant that their owner's equity was smaller, less number of shares, compared to Benson that does not have long-term debt and therefore opted to issue more shares of stock. Remember, all things else in the problem are considered equal. And so as the number of shares increase, the amount of net income per share, of course, is going to decrease. So looking at this, it would appear that Kingston is the superior company because it carries higher higher net income per share of common stock. D, from the point of view of net income, is it advantageous to the stockholders of Kingston Company to have long-term debt outstanding, and why? Okay, so basically, is the long-term debt good for Kingston? Kingston, as it relates to common stockholders. Is this debt a good thing? So based on what we see above, yes, it is, because they're getting more earnings per share. We saw that in C above. The net income, even though net income is smaller because they are burdened with interest expense costs, their taxes are a little smaller because of that. However, net income is definitely smaller for Kingston than Benson, but they have fewer shares outstanding. They have fewer shareholders to spread that net income against. Therefore, each shareholder is getting a higher portion of net income. So yes, the long-term debt carried by Kingston is advantageous to its shareholders. Why? The assets, let's see, acquired from the debt, let's see, $1.2 million of debt. Earn common shareholders a higher return on these investments. So yes, from the point of view of income to Kingston, it is advantageous for the stockholders to have incurred, or the company to have incurred, this long-term debt of $1.2 million. The assets obtained from the incurrence of this debt are earning a higher rate of return than their cost to the Kingston company. So therefore, it is advantageous. E. So we didn't have to calculate anything in D. We just needed to analyze the question and make a response. For E, it's asking us, what is the book value per share for each company? What is book value for each company? So we're just doing some calculations. We do not have to make an interpretation for part E. First, we need to define what is book value. So book value equals stockholders' equity. Said another way, you might hear net book value. Well, what does the net part mean? The net means assets minus liabilities. And we know that assets minus liabilities is defined as stockholders' equity. So book value and net book value in this context are synonymous. And so we're looking for assets minus liabilities, or we're looking for stockholders' equity to be able to calculate what is the book value per share for each company. So now that we've defined book value, the question is asking us, what is the book value divided by the number of common stock outstanding? So let's go find that information. So we're looking for book value. And number of common shares standing. So the book value. We'll turn back over to our balance sheet, and we can find that two ways. So we'll work one way for each company. So we can see them both. We have Kingston and we have Benson. First, let's start with Kingston's, and the book values we defined in the first line on number 35 says the book value equals stockholders' equity. So stockholders' equity is $2 million of common stock plus $700,000 of retained earnings. So the total book value is $2.7 million. For Benson, let's find it on the second line, 36, where we said assets minus liabilities. We know there's 4.2 million of assets. 4.2 million. Given to us in the problem, plus we know that assets equals liabilities plus equity. And then we want to subtract their liabilities. So Benson's liabilities is only 600,000. So the 4.2 million of assets minus total liabilities of 600,000 means that Benson has 3.6 million of book value. Next, we need to determine what are their number of common shares outstanding. We've already found this information above. Kingston had 100,000 and Benson had 145,000. And we brought that back from part C. Right here, we had already calculated the number of shares outstanding. So now we can perform our calculation. Book value per common share. Book value, 2.7 million for Kingston, divided by the number of common shareholders, 100,000, means that the book value is $27 per share. Do the same thing for Benson. $3.6 million was their net book value, divided by the 145,000 shares outstanding, gives a book value of about $24.80 per share. So we can interpret this, even though the problem's not asking for it. We see that as the number of shares increased, even though the book value increased, the number of shares proportionally exceeded the increase of book value, which created a lower book value of $24.83 compared to 27 for Kingston. So Kingston does have the higher book value for each company, and that is because it has fewer number of shares outstanding, even though it also has fewer book value. The lower number of common shareholders are creating a much or $2.17 higher book value per share. And this concludes the requirements to complete question 1419, parts A through E.